Welcome to the Weekly Option, the podcast for people interested in trading stock options. Each week, we cover trade ideas and opportunities in the stock market right now. Whether you're a beginner, a professional, or just curious about options, this is the show for you. Let's get started. Welcome to the Weekly Option. This is episode 69 on July 5th, 2019. I'm your host, Eric. And in this week's show, we will cover the trades from last week on Overstock.com, Macy's, and Advanced Micro Devices. And we discuss 3 new trades on Karyopharm Therapeutics, Twitter, and Altria Group. Now, it's always great to hear from listeners. If you have any questions about the trades presented here on the show, or even about your own positions, feel free to email me. You can email questions to eric@theweeklyoption.com. That's ERIC at theweeklyoption.com. I've also created a short video series to teach you all the basics of option trading that you'll need to understand to be able to follow along with me on this show. You can visit our website and click on the videos tab to watch them, or visit our YouTube channel for the Weekly Option. Now, I hope everyone in the U.S. had a happy 4th of July holiday. Freedom always has a cost, and I thank God for the men and women that paid it so that I didn't have to. Now, the U.S. equity markets managed to finish the week up a little over 1%, even with it only being 4 days of trading. The Dow Jones Industrial Average grew 322 points, ending the week at 26,922 points. The S&P 500 index rose 48 points, ending the week at 2,990 points. Now, the topic of the week is sponsored by the Option Studio. If you want to learn to trade options without any calculus and confusing language, visit the website to learn more about the online course. Visit www.theoptionstudio.com for more information. The topic of the week this week is things that I look for in a credit spread. So last week we discussed the things that I look for in a debit spread, and hopefully you guys found that to be very helpful. Of course, I wanted to follow up this week and talk about my second favorite trade, which is the credit spread. So with credit spreads, I am selling the spread. So I'm receiving a credit to my account, and the only way to receive that credit is by selling that spread from the start. Now, you do not want to sell with the trend, meaning if you look at a stock chart and prices are trending higher, you're not looking to sell call spreads. In fact, you want to go the exact opposite of this trend. So my goal is to find a stock that is trending in a direction that I can notice and sell the opposite direction. So if a stock is going up, then I want to sell a position that benefits from it going down, and that would be a put spread. If a stock is going lower, I want to sell the position that benefits from it going higher, and that would be the call spread. And I always sell out of the money spreads. That way, if the stock price hardly even moves, I will get to keep the premium that I collect when I sell the spread. As far as the amount of premium goes, and those of you who have listened to the show for a while, you probably picked up on this. I tend to look for at least 30 cents of premium or price on a $1 spread. Now that also equates to 15 cents on a 50-cent spread. I found that price region tends to get me the best yield relative to the risk of loss. So when you sell a spread, you're getting paid up front. But that also means that you are open to the remaining value in that spread. So if I sell a 30-cent spread, if I sell a $1 spread for 30 cents, that means I still could lose 70 cents on that spread. So there's still risk to it. The difference is when you buy a spread, like if you refer back to last week's discussion on debit spreads, I'm paying more for the spread in the hopes of collecting less. Here I'm receiving less right off the bat. I'm getting paid up front, and basically I get to play defense or hope that I don't have to pay the remaining value in that spread. And honestly, it's more art than science. So find what you're comfortable with. Maybe you want at least 35 cents to sell a spread. Maybe you want 20 cents on a dollar. It just depends. You just like to sell spreads. And when I was on the trading floor, we were far more likely to sell options and sell spreads than to purchase them. So I have a natural comfort with selling spreads because of my years of being down there and just seeing how things work out, especially if you understand how to manage risk. So if we sell the spread, that means we want the spread to expire worthless, right? And that ultimately means that we are selling. I sell the strike that is closest to the money, and I need that strike to remain out of the money. So let's say stock right now is trading for $25, and I'm going to sell a call spread. I'm going to sell the 25 half or even $26 call spread, 26, 26 half, or 26.27. I'm not going to sell the 24.50 strike because that would be in the money. So it's important to know where stock is trading and understand what out of the money, at the money, and in the money actually are. I'm cautious if the out of the money spreads are priced out of that range. If they're priced too high, I'm cautious simply because that's typically a sign that there's a higher likelihood of that trade expiring in the money. There's a lot to be learned from the option price itself. And if options are priced extremely high, my assumption right off the bat is that the professionals who are pricing those options have some information or some reason why they have that spread priced higher than they otherwise would. So now it's on me to dig for more information and truly understand what's happening. Is there an earnings announcement coming up? Is there an FDA approval? Is there some other sort of news out there that will affect or is affecting the stock price? Has there been a leadership change? Have they added a new product line? Is there a dividend coming up? There are all sorts of things that are going to be priced into the option itself. So if I'm normally looking for 30 cents a premium out of $1, and I see a credit spread that's being priced for 45 cents, I'm cautious. Absolutely, I want to sell it, but I also am aware of the fact that there might be something else priced into that spread that I'm not aware of. So I then need to do more research and make sure that I'm not about to catch a falling knife, is really the way we used to talk about it, or just get run over by a Mack truck because I didn't have all the information. And certainly as you trade credit spreads, you'll get a better feel for what works best for you and for your own portfolio goals. And that's what makes this more art than science, is the fact that you can understand what makes you money and what will cost you money. You can understand the trend and how to acknowledge which direction a stock is going. But there are people out there that don't mind selling a 20-cent spread. Some people wouldn't sell a spread for less than 45 cents. So they're looking for special situations. I myself have found that 30 cents to 35 cent price range equivalent on a $1 spread tends to work well for me. Let's get into the trade review for last week, of the trades last week. We'll start with the covered call. We had Overstock.com, symbol OSTK, Oscar Sam Thomas Kelly. Stock at the time was $13.61, and I looked at buying that stock and selling the July 14 call at 95 cents, hoping to yield a 9.93% return in 3 weeks. Well, Overstock.com shares grew $1.12 this week, closing at $14.72 per share on Friday, today. The call option we sold is in the money, which means that we keep the premium we collected when we sold the option, and we will sell our stock back at the strike price of that option, which is $14 per share. So if you were to buy back the call option you sold and keep the stock that's gone up $1.12, your total profit at the moment would be 47 cents. But by waiting to get assigned on this call option, getting assigned is when the exchange or when your broker lets you know that the person who bought that option is going to exercise it and receive the shares. So if you wait to get assigned on the call option, you will actually net $1.35 per 100 shares. So think about that. If you close the trade out ahead of time you make 47 cents. If you wait for this option to expire in the money, you're actually going to make $1.35 per option. So that's why I don't typically try to close the trade and catch more of the run up in the stock. I have to really believe that the stock is going to run far to make it even worthwhile. I would always, collecting $1.35 versus 47 cents, that's 3 times the return just for sitting on your hands for 2 weeks. So you better believe I'd sit on my hands. Now, our next trade is the credit spread. And we looked at Macy's. We've looked at Macy's before in the past as well. Symbol M as in Mary. At the time, the stock was trading for $21.46. We looked at selling that July 21.5 22 call spread, collecting 18 cents, and that can yield a maximum loss of 32 cents. Well, Macy's stock finished the week 24 cents higher, closing at $21.70 per share on Friday. The out-of-the-money call spread we sold is partially in the money at this point. In fact, it has 20 cents of intrinsic value. Now, the spread itself can be repurchased for 26 cents, marking an 8 cents loss on the week. The stock could certainly fall lower, or it could end up just trading sideways for the next 2 weeks. It could also push a little higher. So given that the loss right now is so small, I might consider just closing the trade and saving the rest of my capital. Again, this is a 50 cents spread. We collected 18 cents on it. Our maximum loss is 32 cents. Right now, we've lost 8 cents. So there's another 24 cents that can be lost on this trade in the next 2 weeks. So if you're committed to the trade, you can also consider selling a put spread against it and creating a more range, a larger range of profit, and possibly minimizing your maximum possible loss by collecting more money for this overall trade. The problem is that sometimes selling that put spread against a short call spread can almost guarantee that you're going to lose on one of the sides of the trade. In this scenario, I'd rather just take the 8 cent loss and walk away. Sometimes it's best to walk away, keep your capital, and look to invest it or trade it in the next trade. Our final trade last week was the debit spread on advanced micro devices, symbol AMD, Apple, Mary, David. At the time, the stock was trading for $30.37, and we had purchased the July 29.5 30 call spread, paying 32 cents, hoping for a maximum gain of 18 cents or 56.25% return in 3 weeks. Well, AMD stock rose $1.13 per share, closing at $31.50. The in-the-money call spread we purchased last week is even more in the money now. So with stock above $30 per share, we know this spread will expire worth 50 cents. And that is our gain of 18 cents per spread, or the 56.25% return. Now, if you were to try to sell it back today, the market makers would buy it for 32 cents, which is no gain. But you and I both know that this spread has more value because it's in the money, right? It's fully in the money. And even the way they're pricing it, it would cost you 42 cents to buy more of this spread today. So I'd ride this one out and keep an eye on that stock. You do not want the stock to fall below $30 per share because that'll lead to a loss. So it's nice to have a decent enough move in 1 week to have a 56% return on your capital. Now, of course, July has 2 more weeks until expiration, so you have to be vigilant in protecting your profits, but sometimes it's good to also just sit on your hands and let the money come on in. So that's not bad this week. 2 out of 3 trades were winners, and the one that's a loss is a small loss, which will keep us in the game and allow us to keep trading on for the next week. So once again, only 2 weeks left in July expiration, so this will most likely be the last week that I present new July trades for the week. So we'll start off with the covered call like we always do. I'm looking at a company I hadn't looked at before, Karyopharm Therapeutics, symbol KPTI, Kevin, Paul, Thomas, Isaac. The stock ended the week at $8.81. I'm looking at buying that stock and selling the July 10 call, collecting 30 cents per option, and hoping for a yield of 16.91% in 2 weeks. Now, you enter this trade by buying KPTI stock for $8.81 and selling the July 10 call at 30 cents. This trade makes the most money if stock prices finish above $10 per share, and the break-even price is $8.51. Our next trade for the week is the credit spread. We're looking at another company I follow occasionally, and that's Twitter, symbol TWTR, Thomas William Thomas Richard. Stock ended the week priced at $36.25 per share, and I'm looking at selling the July 36.5 37 call spread, collecting 18 cents, and that can yield a maximum possible loss of 32 cents per spread. Now, you enter this trade by selling the July 36.5 call at 69 cents and buying the July 37 call for 51 cents. This is a credit spread because we are selling the spread. This trade makes the most money if stock prices finish below $36.50, and the break-even price is $36.68 right now. And once again, just as in the topic of the week, I look at the stock and just see where it's trending, and Twitter stock right now appears to be trending lower, and that's why I feel comfortable selling a call spread. But of course, we'll see what the market gives us over this next week. And then our final trade for the week is a debit spread on another company we've traded in the past, Altria Group, symbol MO, Mary Oscar. The stock ended the week at $48.78 per share, and this time I'm looking to buy a July 49 put spread, paying 33 cents for the spread, and hoping for a maximum gain of 17 cents or 51.52% return in 2 weeks. Now, you enter this trade by buying the July 49 half put for $1.13 and concurrently selling the July 49 put at 80 cents. This is a debit spread because we are buying the spread, and this trade makes the most money if stock prices stay below $49 per share. And overall, the break-even price for this trade is $49.17. The break-even price, of course, is the price at which you have neither made or lost money. So as always, that's the reason I give that price. It's important to know all your metrics, and that's a good one to know. So our final thought on the week is that this week I am short a call spread and long a put spread. That's essentially like being short stock, a short synthetic stock, if you will. So if the market is down a week from now, my trades will make money or should make money. Likewise, if the market is overall higher next week, I'm most likely going to lose on these trades. So it's always good to know as well what stock market direction your trades are favoring, because if, like what I've done today, if both trades favor a specific direction in the market, then it can give you a reason to pause. Of course, I like the trades that I suggested, so I'm not going to change them, but I am well aware that if the market shoots up higher on Monday, I probably need to do something to protect my capital on these two trades. So that's it for the week. Hope you guys are having a fantastic weekend. For those of you who are continuing the celebration of July 4th and just rolling it into a 4-day weekend, be safe, have fun, and we'll see you guys next week. Happy trading.
Thank you for listening to the Weekly Option Podcast. Please subscribe to our show and visit us at www.theweeklyoption.com. Disclaimer: there is a very high degree of risk involved in trading. The indicators and strategies described in this podcast are for educational purposes only and should not be construed as investment advice. For our full disclaimer, visit our website at www.theweeklyoption.com.